Thank you, everyone, for coming to listen to us. What I thought I'll do today is talk a bit about offshore investing. And rather than one long story or a business case for offshore investing, I thought let me just deal with some of the challenges that comes up in conversations with yourselves, with clients. So we've done a lot of research on offshore investing. And typically, this is the type of challenges that clients throw to yourself or to us when it comes to offshore investing. So I'll try and see if I can debunk some of these myths or at least give you our view on these things. Um, if you would forgive me, I'll try and oversimplify here. None of these issues are simple issues, but I'll try and make it as simple as I possibly can. Happy to discuss them in more detail. One of the first questions I typically get is, are we as South Africans too heavily invested in our own stock market, our own country? Now, look at the global research. It's actually not a unique South African thing. It is well known throughout the world, and they call it home bias. This is a study by the IMF, and it shows for clients in each of these countries, when they invest an equity portfolio, what proportion of that equity portfolio is in their home market? And you will see many of these countries are very, very close to 100%. I've highlighted South Africa in red, about 80%. And it goes down all the way to even the Netherlands. They're a bit odd. They probably think the grass is greener on the other side. They've got it the wrong way around, yeah. But the two other countries that I've highlighted here is United States and Japan. Why specifically did I highlight them? I thought these are the two biggest stock markets in the world. Probably one of or two of the most diversified stock markets in the world. And in the not so recent past, you can see the US stock market, although it was a bit bumpy, effectively there's been a flat 13 years of no returns. Now, in the last 3 years, I've had many, many conversations with clients and advisors about where are returns in South Africa. We've had 3 years flat. Nowhere can we see returns coming from. Imagine the conversation if you were a financial advisor in the States. Or, more interestingly, if you were a financial advisor in Japan. That's 31 years of no returns from the Nikkei. So what point am I trying to make here? As an advisor to clients, you can do everything correct. Do correct financial planning, sit with your client, correct asset allocation, pick the right managers. But if you happen to go through a period like this, it could be quite painful. So it brings me to the whole issue of when clients ask us this question, how much should I invest offshore? When they ask us as an asset manager, we think in terms of, for this fund, let's take Prudential Inflation Plus. For us, in order to meet the investment objectives of that fund, inflation plus 5 gross, and the risk parameters, how much offshore do we meet? We do all sorts of analysis. We come up with the answer, roughly 35%. But that is something very different to when you sit with a client and do holistic financial planning and you take all the client's assets and liabilities into account. And sometimes you say, okay, Prudential said 35% in terms of financial planning, I also need 35% offshore. Those happen to sound similar, but there are two very different problems you're trying to solve here. So you guys are the experts in financial planning. I will focus mostly on the investment side today, but I'll mention a couple of things. One of them, obviously, I'll touch on pension fund. For most clients, that is the biggest asset that they hold outside of their property. Just in terms of your discretionary money, how much assets can a South African take out of South Africa? And we all know it has increased quite dramatically. Today, you can take 10 million rand out of South Africa as your discretionary allowance plus your 1 million travel allowance. For most South Africans, that is not a problem. It used to be a problem for the Visas and the Justas of the world, but apparently not so much anymore. It has certainly come a long way from the 200,000 in a very, very short period of time. So from a discretionary perspective, you can take a lot of assets offshore, or just from an investment perspective, you can effectively invest unlimited in global rand-denominated unit trusts. From a Reg 28 perspective, covering pension funds, we were surprised recently that the 25% allowance jumped up to 30% in the latest budget speech. Obviously, it excludes the 10% into Africa, which I'm ignoring here. Is 30% enough? Maybe, maybe not. But I can tell you it's a hell of a lot better than the 5 and the 10% we did see not so long ago. So we're certainly on the right track here. So let's focus on the pension fund assets. As I said, it's the biggest asset, and this is maybe a picture I've shown you guys before. As a proxy for someone's pension fund, I've used the average South African balanced fund, unit trust. This is data as at the end of Feb this year. I don't know if you'll remember, at that time it was still a 25% offshore limit, and the rand strengthened significantly over the first couple of months. After the Ramaphosa effect, the rand turned at 11.55 to the US dollar. So the average fund was slightly below 25% purely because of the rand strength. But as we know, so these are all the offshore assets. This is literally, if you go and look at the fund fact sheets of all the funds in this category. This one is the particularly interesting one. We know these are offshore assets, but in terms of domestic equity, which I've got a 0 there, we know corporate South Africa has externalized a lot. We have heard about things like rand hedges. You guys know this a lot better than I do. Here are example of 15 of the largest stocks in the ALSI. This is the percentage of their total earnings in the teal color coming from outside of South Africa. So many of these stocks you see are very close to 100% earnings outside of South Africa. So what happens here? When the rand weakens, the stock market goes up as a result of these shares, counterintuitively. So we need to be quite thankful that many of these companies externalized on our investors' behalf. Many of them burnt a lot of fingers overseas, but there's some decent offshore exposure. So if I were to add up all of the offshore and local exposure of the entire all-share index, you get a picture that looks as follows. Of the ALSI, about 55% of the earnings comes from outside of South Africa. Take the cap SWIX, the number is slightly smaller. Try to do the same for the property index. I took the NAV of all the property companies, or my colleagues did. It got to about 30%. So if I were to take the 30% offshore and 55% offshore, plug it into the original table, the picture changes as follows. So it's not 25%, the 30 and 55 comes in here, and the average SA unit trust fund sits on about 50% offshore exposure. So it's not the 25 that our clients typically think we are sitting at. Looking at, this is the balance fund category, I thought it may be useful to show a couple of the other also popular categories: multi-asset income, conservative balance funds, flexible and equity. Again, if you look at the fund fact sheets, this is the picture you get. If you use my approximations of offshore earnings of SA listed equity and property, as I've done with the balance fund index, the picture changes slightly. Come up with, across those, about 45%. Now, in terms of, so far, we've discussed quantum only, how much offshore, and I think that's quite important. But we haven't spoken about quality. What do I mean with that? If 45% is roughly offshore, is that the right offshore that you want? So that may be quite difficult to look at, so I'll show you two examples of ways how I try to quantify quality. The one is to look, where does the earnings come from? The picture that I've put on the screen here is probably the most used global index, the MSCI All Country World Index. If you break the earnings into geographical regions, you get the bulk of the The global index comes from the Americas, Asia Pacific, and Europe. This is earnings, as you would expect. If I plot the all-share index on the same graph, you would, as expect, you would see we're heavily overweighted to South Africa, even Africa, and underweight as a result the other regions. Now, this is not a bad news picture. I think, again, as I mentioned, South Africa, corporate South Africa has diversified already quite a lot on our behalf, which I think is a good thing. But I want to ask you to remember the two slides of Japan and the States that I've shown you earlier. Being exposed to a single stock exchange or a single country can have risk, even for very large ones. A different way to slice and dice this is to look at sectors. So we all open newspapers and we hear about high growth tech stocks, high growth biotech type of things. So if I break it down into sectors, you'll see the one obvious thing is we're overexposed to the basic materials, mining mostly. So a different way to look at it, if you add the number of stocks in each of these sectors, you would expect South Africa to have less options to the global index. Why do I show this? I think two reasons. One is, how big is the opportunity set for your clients to invest in? Are there growth opportunities? The other one is, can I diversify away? How many stocks can Chris choose from to diversify enough? Now, in the mining sector, there's 26 companies listed in South Africa. Many of the world's largest mining companies are listed here. Anglo's BHP Billiton, that's actually quite good. Maybe the only one being not Rio Tinto here. But if you look at energy or oil, effectively we can choose from Sasol or Sasol, which luckily has done quite well. But globally you can choose Royal Dutch Shell, BP, Chevron, Mobil, a lot more options. The risk is Sasol goes and builds a massive plant in the US, oil price fall, and Sasol gets hurt. That's the risk to our clients. Similar in different sectors, we were very, very fortunate to have a company like SAB Miller, and our clients being exposed to them eventually got taken over by AB InBev. Luckily, that is still available on the all-share index, but globally you have Heineken, Diageo, Coca-Cola, one of Warren Buffett's longest and most favorite holdings, much more options. The problematic area on this graph for me comes here. Technology, for example. 3 technology counters on the ALSI, EOH, Ultron, and Datatech. I've put Naspers here because I think by pure coincidence, Naspers, which is a consumer service, happens to be the biggest tech stock on our stock exchange because of the investment in Tencent. Now, we were very, very fortunate that that happened for us. But globally, you could choose from Apple, Facebook, Google, Tencent, Baidu, all of these things. The opportunity set is just a lot bigger. Now, why do I show this? Why is this relevant to you? You probably know all of this already. If I just take what I think has happened already, as I said, this is the basic materials index on the JSE for the last 10 years. Marek and Sandile alluded to the issues in our mining sector. We've had no growth from the basic materials sector in the last 10 years. That's one of the reasons your clients are feeling pain. And I've also shown you that the sector is about more than 50% of the JSE's earnings. So it is material in your life. Compare that to something on tech sector globally. This is the MSCI technology sector. 12% per annum over that 10 years. It turns out to be a 233% difference. Opportunity set, risk diversification. This is important, and it is important in your client's life. So when we look at these things, we thought, how can we assist? What can we do? We had a relook at our global funds, what we offer, and our offering was quite thin. So what we decided to do over the last 2-3 years, we created a new global fund range in Ireland. Effectively, Irish domiciled in the EU under the EU legislation, US dollar denominated, a comprehensive but very simple range: global equity, global balance, global inflation plus global bonds. Very simple range. We also looked at our current rand fund of funds or global fund of funds that you can access here. We've had 3 funds. We are starting now with a process to ballot them, to change them into a carbon copy of the funds offshore. Those funds will then disappear after the ballot, so that effectively what we can offer our clients is 4 simple funds. You either buy it in South Africa in rands over here, or you go offshore on an external platform and you buy it in dollars offshore. Very simple, whatever is more convenient for your clients. What are some of the thinking we thought about in terms of when we set up these funds? We are obviously quite late to the party here, but that also brings the benefit of we could think and see what are the things that work well and what doesn't work well. So a couple of the things that we've done is we've created these funds with our global parents, global partners, M&G Investments. But more importantly, we designed from a South African perspective the mandates. What does your client need? We see many funds being sold in South Africa with a very strong UK or US bias. We've built it from a South African client perspective by South Africans, obviously with the input of our M&G colleagues. Many of you would know Mark Beckenstrater, our previous CIO. That's where he currently sits now in the multi-asset team. They manage the money. They sit with 140 investment professionals. They've got long-term track record here, and they assist us with managing that money. Security is a very big thing for South Africans, so we made sure we chose the right jurisdiction in Ireland, the right European set of fund standards that we operate under. And in Ireland, well, firstly, they speak English there, which helps. And secondly, we could access many or most of the best service providers in the world in terms of custodians and safekeeping and banks and auditors. I know you will not invest just in a new fund. These funds will have a 1-year track record in June, and you will look at 3-4 years for a decent track record, and that is absolutely fine with us. The one thing that I can tell you is all of the global discretionary money that we have, we've put into these funds. So in Prudential Balance, Prudential Inflation Plus, you'll see the Irish funds are as building blocks inside those funds. So we think we've set up everything correct that we needed for our clients, and we take that responsibility very seriously. I think I would have to end off on the client behavior side of things, which I think is very important, and particularly with regards to offshore investments. And what I've done here, the question that I get most is the question about the rand. And I think as South Africans, we are potentially too focused on the rand. And I'll show you some examples. The first thing is, I think we have to remember the rand is an asset. And you can value that asset. Now, it's not so easy to value this asset, but there are many different models. What I've put here is a purchasing power parity model. So the gray line in the middle is a proxy for the value of the rand, and the red line is the actual rand. Those are 10% over and under. What does purchasing power parity mean? I think it's a fancy word for saying if I take the rand versus the US dollar, the rand should depreciate against the US dollar at a rate equal to the difference in inflation between the two countries. So if long-term inflation in SA is about 6%, long-term inflation in the US is about 2%, 4% difference. So over a long period, the rand should depreciate against the US dollar at about 4% per annum. You haven't got richer or poorer when that happens. Okay, you are even money. The problem is the rand doesn't play that nicely. It's obviously very volatile, and over the last couple of years, where I want to focus on, we've obviously seen a period where it's gone from quite strong to quite weak very quickly. So if I focus on this last couple of years, if this is the valuation, the purchasing power value line, when the rand is above this line, the rand is strong. It's an expensive asset. I don't know if you can remember, mid-2010, you could buy a dollar worth about 6.62 rand. Right? Very nice times. Buy cheap TVs and all of these things. All things being equal, you want to sell an asset when it's expensive and buy another asset when it's cheap. Right? What I've done also in terms of looking at the behavior of SA clients, these are the net flows. So that's about 2 billion rand per quarter of all the flows into global unit trusts in South Africa. All the global, worldwide, all those, I've added them all together. These are the flows. And if in this period when the rand was strong, when it made sense to sell expensive rand, strong rands, buy cheap dollars, South Africans have taken about 22 billion rand offshore, which is, again, all things being equal, a good trade. What happened consequently? We all know the rand started weakening and went down, I think, to about 1586 to the US dollar, very, very weak level. So there the rand was about 30% expensive. Here the rand is about 25% cheap. That's from here to there is about 140% slide. So there you got 140% more dollars for your rands than at this point in time. So what did South Africans do? If you opened the newspaper here, everyone was offering cheap and free advice. We are the next Zimbabwe. Take your money, leave the country, run as hard as you can. And South Africans took about 66 billion rands just into rand global funds. This excludes externalized money. This is a slightly longer period, but gives you an indication. So when you get little dollars for your rand, we take 3 times more money offshore. That's where you guys can come in and help manage the behavior of your clients, which I think is absolutely critical, because typically that client will take a very, very long time to make up his money again. So that was it from our side. I just wanted to share with you a couple of the challenges or the myths that I typically hear and try and unpack them and try to make them as simple as I possibly could, and show them our view on these things. I sincerely hope that when you do your typical financial planning or holistic financial planning for your client, you would try and manage your client's behavior, that they don't overreact to the rand, and when they think it's a good time to take some money offshore, that you'll consider Prudential as a potential investment destination as well. Thank you very much for your time.